continue our conversation with the TCS management. With me now, Rajesh Gopinathan, the CFO, and Ajoy Mukherjee, the head of Global Human Resources. Rajesh, Ajoy, thanks very much for being on CNBC TV 18. Rajesh, I'm going to start with you first on a currency question. It's been a tough couple of weeks with what's gone on with global currencies. What's your outlook on that? How do you see that impacting business over time?
So, as you said, it's been a very volatile period.
Has, yeah.
We are covered into Q3, Q4 as we typically do, 2 quarters forward, which gives us the headroom to adjust ourselves some. But essentially what you're seeing here is a huge cross-currency divergence,
right,
which has never been as dramatic as it has been in this. We need to take a call on this as to a lot of it is also still driven by central bank interventions.
Sure.
So we've got to wait and see how that plays out, because that will have a material impact on where it goes. But it's uncharted territories,
sure,
and currently we are not changing business strategies based on that. But if the divergence continues, it could have material impact on some of our numbers.
Okay, so can you talk me through what you mean by that material impact? And you also said we need to take a call on this, and I'm trying to understand what that specifically means.
So the best way to think about it is go back a year back when we were running at about 30% margins. And a lot of that was coming in due to the moderation on the currency side. And we had said that we will calibrate our investments based on the headroom that the currency provides us. And we have done that.
Sure.
We have sequentially invested into consolidating presence in France, Japan, new service lines, investing into digital, etc. And we are fairly comfortably placed in the midpoint of our target margin band. Sure. If the currency situation were to turn in the opposite direction, right, and introduce a lot of margin headwind onto us, we would need to start recalibrating our investments. And broadly, that's what we have been expecting to do. But the call on when to start changing the strategy will be taken after we see some amount of stability coming into it.
Okay. When you say opposite direction, by how much would it have to turn in the opposite direction for you to do all of this, which is reassess your strategy on currency?
Not a thing, but if you look at where the euro is, it's in a bit of a free fall.
Yeah.
GBP is also now starting to go into it. So I have a lot of my business into those markets. It's never a single threshold over which, but it is more a directional comfort. If you think that this is likely to continue, then we would need to start relooking at what our overall investment plan is.
Okay. On the margins front, you've, like you said, in the midpoint of your stated band, Japan has added 2.8% to your top line, but hurt your margins by about 48 basis points.
Right.
Chandra says that he's not looking or worried about margins in Japan growing, but that's a sort of a top view. I'm wondering as CFO whether you're estimating that this pressure on margins will continue or persist, thanks to Japan, or do you expect Japan margins to come close to your, global average margins anytime soon? Can you give us some sense of what your outlook on that is?
In fact, we were expecting a lot worse, and it will be, because we were expecting close to a 70 bips impact due to Japan consolidation.
Okay.
That entity that we have taken operates in the mid, about 5% kind of a net margin level.
Okay.
Because of the technicalities of the integration, this quarter we are coming in at 9%, but that is just, as I said, a technicality of the integration, which means that I still have another 4% impact that will come for me as I go forward.
Okay.
The way to look at it is that structurally we are very confident that we'll be able to take the margin up, but we are talking about 2-year, 3-year kind of a horizon. The next 4 to 6 quarters, our experience in all other integrations are that it's typically margin dilutive.
Right.
So you go in and further dilute margins because you are investing ahead of the business.
Sure.
So that's likely to happen. So it's going to give headwinds on it.
So are we expecting what, another 20 to 50 basis point sort of decline in margins thanks to Japan? Yeah, that would be a fair way to say. So it seems that you will, for at least the next few foreseeable quarters, come in closer to the 26% of your 26 to 28% band. That's a fair assessment?
That's a fair assessment. Typically Q3, Q4 are quarters where we actually expand our underlying margins a bit.
Okay.
But that again is a play on exactly how Q3
But how is it
works
that?
out.
Because Q3 is seasonally supposed to be a weak quarter for you, right?
Yes,
so how do
but
margins expand in such a quarter?
Margin expansion is as much a predictability issue as it is a weakness issue. If I predict it right, if I can take the calls right in terms of where the revenue is coming and what the mix is like, I can align my cost structures to that. So typically you would have seen that on that, both from a realization as well as margin perspective, typically Q3 we are able to manage it. But we are going in with a slightly more volatile environment than what we would have ideally liked. So it is Q3 has to be assessed in retrospect rather than going in. So the intents are always there. So where we end up with margins, we'll have to see. But the intent is still the 26 to 28 range. I think we have sufficient headroom to take care of the dilution that Japan will create. And what happens on the currency front, we'll have to wait and see.
What is the percentage chance that you won't reach 26% given some of these headwinds that you outlined over the next couple of quarters?
Fairly confident that into this Q3, Q4 season, we should be fairly able to.
Of 26% at least, right?
Absolutely.
Okay, fine. What is your expectation from the Japan business and its overall contribution to your revenue in the next few quarters to come? So I think Chandra put it at about a $500 million business right now. Can you give us a sense of over the next year or two,
See,
what
the next few quarters is, as I said, going to be a bit more volatile. But if you were to take a 2-year horizon, that's a market that should see decent, I would say, well above 20-25% kind of a growth on a year-on-year basis.
And therefore, contribution to revenue from this Japan business will grow by how much between what it is now? It's 500 million now, right? And you're doing.
So the way to look at it is, it's about including our existing business in Japan. We are at about 135 to 140 million kind of a range, and probably, unless things go wrong, we should be looking at a revenue contribution anywhere between 8 to 10 million Q on Q after it stabilizes. So let aside the next few 2-3 quarters, but if you take a 1 to 3 year kind of a perspective, probably all things being equal, we should be looking at that kind of incremental revenue coming in from Japan.
Our realizations have been declining over the last several quarters now. Is that a cause for concern? Is that a sort of a mix issue? What is the reason why we're seeing lower realizations, or is it just pricing pressure?
No, it is primarily pricing is in a fairly stable band. It's a mix issue. If you look at your where the growth is coming from a geographical perspective, as a percentage of revenue, US, UK, Europe are all declining, and the growth is becoming more broad-based. So the realization is actually a local market headline number related one. If you look at more structural elements of it, our employee cost as a percentage of revenue has actually come off this quarter, and which is a better mix in terms of the value measure, which is why our overall margin has actually improved. The margins, even after the Japan integration and setting off the depreciation benefit we got going into this quarter, we still have a margin expansion. So realization, as the business becomes more complex, as the mix becomes more complex, I think it's a metric that needs to be now seen in perspective.
So it will continue to decline? Is that
the service mix also, the geographic
service mix is there
mix as well?
So
will it continue to decline is my question. I mean,
it is difficult
what
to
should
take
we expect from here onwards?
It's difficult to take a call on it. If again, as the geographical mix were to change, it will go back up. Rather, so it's very difficult to take a call on it based on it. It's not a measure on which we drive the business on, whereas the margin side is a measure on which we drive the business.
I want to talk about the CMC merger, but before that, I want to bring Ajoy into this conversation. Ajoy, thank you for waiting patiently while I went through some of the numbers. Hiring guidance, I think 35,000 freshers is what you put out yesterday, if I've got that number correct. Do you want to sort of run me through what your hiring guidance for the year is, based on this next quarter assessment?
See, as far as the current fiscal is concerned, we have said 55,000 will be the total
and
hiring.
you're on track for that?
I'm on track for that.
Okay,
because first 2 quarters, if we see, we have done 36,000 at this point in time, and we are fairly confident of doing 55. We probably will overshoot that, but by how much, that is something that is difficult to calibrate at this point in time.
Okay.
As far as the next fiscal is concerned, what we are doing is the campus season has started. We are already in the campus mode. We have visited a number of campuses and we have already given out offers. The total that we are targeting is about 35,000 fresh offers that we will give for for the candidates to join in the next fiscal. Now, the total hiring target for next fiscal, we will announce somewhere around Q4 by the time we complete our business planning and things like that, which will be somewhere around February, March timeframe.
But do you expect to do the same kind of hiring or more than you as you sort of put out for FY15?
As I said, that will be, we have not done that number yet. But from trainee point of view, we have definitely done that. And that is what is 35,000 is what we have announced.
Okay. Utilization is at an all-time high of 86.2%.
Yes,
I ask you this question every quarter. Is there scope for this to increase?
The scope for improvement is of course there, because 86 means 14% of the people are still on, people like me, people like all the investment that we do.
Do any of your competitors do 100%? No, right?
Nobody.
Yeah,
See,
exactly.
because you will have people who are not on customer engagement.
Yeah.
And
so how much more can you eke out?
Yeah, if you look at the utilization including trainees, that is at 81%.
Yeah.
Even that is at all-time high. So see, as long as you are in growth mode, you will continuously have people coming in whom you are training, and as you are venturing into new technologies, for example digital, there will be a number of existing staff who will have to reskilled on this technology. So there will be a fair amount of learning development kind of investment that will be going on. So going towards 100% or increasing it from where we are is going to be a bit challenging, but at the same time we have to measure our margin of expectation as well. So we balance that out at a given point.
So what you're telling me is expect better utilization in the quarters to come.
At this point in time, I won't say expect better, but expect definitely around where we are at this point in time. It's 86, 81%. So because next quarter again we'll have a number of trainees who are going to come in. So overall utilization including trainees, that is something that probably may see a bit of softness from where we are at this point in time.
Okay.
But overall, the number should not change too much.
Okay. Attrition, you're at an industry low, but still you've seen a sort of inching up of attrition.
Right.
It's now up to about 12.8%.
Correct.
Why is one question. And second question attached to that is, are you seeing some pressure as, some of your key competitors, for instance, Infosys, get a new lease of life, right? We're seeing signs of revival there finally after many, many quarters. So is that sort of adding to the attrition pressure?
See, attrition, there are two factors to it. One is the seasonality of the attrition. Q1 and Q2 typically is higher than Q3 and Q4, primarily because people go for higher studies. And if you look at the MS admission, etc., that goes on till about mid-August. So up to that time, the attrition numbers, absolute numbers continue to increase, and then you see that declining. The second reason was because you complete your annual appraisals and promotions and everything else. So there are a few people who decide to leave and look for opportunities outside. So that is what plays out in Q1 and Q2. The third factor is, of course, the overall demand as far as the industry is concerned. That is what I think you are referring to. And yes, as the demand, as the industry grows and overall within the country, then there will be pressure on people. There will be pressure on talent.
Signs of it already?
There is not some amount of science, yes, because that is what is one of the reasons why it is going to 12.8 from this. But at this point in time, we are not that concerned, because overall from a retention point of view, we are able to do it, and we are looking at the absolute number of exits at this point in time that is coming down. So I think we are pretty confident of retaining our retention levels to the highest benchmark as far as the industry is concerned.
Okay. Final question to you then. I noticed a slight shift towards local delivery. So the numbers are at 48.9% versus, I think in the previous quarter you did 47.1. In the comparable quarter, year on year, you did 46.5. This is versus remote delivery. Why are we seeing this shift? I'm sure that also has an impact on your margins in some fashion or the other. Are we going to continue to see the shift towards local delivery?
Yeah, as you have more and more local delivery, that the cost of that is going to increase. As a result, that will have an impact on margin. But as far as this quarter is concerned, this is primarily because of the Japanese integration.
Okay.
The entity that we have taken over. So most of it is on-site delivery. That is what has caused this particular shift. But that is not something that we are seeing as a trend, that more and more of on-site delivery is not the trend. Trend is more and more of offshore. So that is a balanced view. And Rajesh, if you want to add on
would
that.
You want to add on
on that from a Japan integration point of view,
or a margin impact
point
of view, are we going to see these numbers shift more and more towards local delivery?
No, it again will depend on how the geographical mix turns out, because when you see differential growth in Europe or let's say Japan, it will tend to come with a higher on-site component, because these are markets where we are still in the market development mode and the model is still not stabilized. So, whereas from the service mix perspective, service lines like remote infrastructure delivery tend to be much more remote location optimized. So it's essentially a portfolio call.
Okay.
The one-time jump that you saw was Japan. So on a Q-on-Q basis, you will not again see it next quarter.
Okay,
the big
fair
jump.
enough.
So for example, BPO, if you look at majority of it gets delivered from offshore. But at the same time, if you see a lot of growth in the Latin American market, a lot of that will happen from an on-site location. So it depends upon the market.
I get it. Okay, fine. Final question then to you, Rajesh, and that has to do with CMC. I was asking Chandra why you all chose to do the merger now, whether there was any time trigger to it. He says no, but he does say that there are synergies to be had in combining teams, in cutting down overheads. Can you put a number to what those synergies will be? Are they going to be material at all in any way to your margins? Because otherwise you only anyways consolidate the financials, so there's really going to be no other big financial impact except for the equity dilution.
So from a number perspective, the only number that will have an impact is we have the minority interest that goes away before net profit, which will not be. So at an EPS level, based on the trailing 12 quarters, 12 months perspective, there is a marginal uptick on the EPS.
Right.
Yeah. Otherwise, the numbers are such that it will not have any material impact.
Okay.
From a corporate structure perspective, these are two entities, two listed entities operating in the same market, which is always, it is from a positioning perspective, it is not a very desirable one. And it also introduces overheads in terms of record keeping, in terms of arm's length transactions, ensuring that governance, difficult to quantify from a cost perspective, but from a sheer management drag perspective, it is much better to consolidate the structure. And as organizations grow, these kind of entities keep on.
Why now?
On a timing perspective, I don't know whether Chandra shared it with you. October 16, 2001 is when the first transaction was done, when the acquisition was done. October 16, 2014 is when it is.
Really? Really? Well, he didn't tell me that. All right, gentlemen. Thank you very much.